Hi, I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. With 80% of the results season complete, I thought I might provide a few insights into what the company report cards have told us. Heading into the results season, there was a general expectation that risk was skewed to the downside. We have noted in the past that pressures are building on the household. We expect these pressures to intensify through the next 12 months. As such, company outlook statements will likely be the primary source of disappointment for the market rather than the backward-looking financial results themselves. The general tone of the results was indeed one of disappointment, with around 15% of companies reporting better than expected results, while 27% of companies disappointing. This is almost the exact reverse of what happened in February, when 25% of companies beat expectations and 18% disappointed. Given most companies update the market prior to reporting results if their earnings are likely materially different to analyst expectations, it is the impact on analyst forecasts for the coming year that really shows the degree of surprise for the market. So far, analysts have revised down their fiscal 18 net profit forecast by around 1.7% on average. However, if we break this down into its components, we note that forecasts for resources companies actually increased 1.1%, banks increased 0.6%, and industrial earnings forecasts for fiscal 18 decreased 3.3%. Looking at the drivers of the downgrades to the industrial earnings forecasts, revenue growth forecasts actually increased from 4% to 5%. This is interesting given slowing revenue growth momentum in the 6 months to June. Surprisingly, revised market forecasts imply stronger revenue growth in fiscal 18 than in fiscal 17 for industrial companies. This appears optimistic given the growing constraints on the domestic economy and the impact of the appreciation of the Australian dollar on translated overseas revenues. Reduced margins expectations due to cost pressures and increased investment in OPEX are the source of the reduction in industrial company earnings forecasts, with fiscal 18 EBIT forecasts falling by about 2%. As of last Thursday, 34 of 49 industrials reporting had fiscal 18 EBIT downgrades versus 15 upgrades. We note that margins are still expected to increase in fiscal 18, but at a slower rate than was previously expected. One of the sources of reduced margin forecasts is increased investment by companies. Whether this is a positive for the economy and stocks really depends on whether this investment is expected to deliver a future earnings growth payoff or whether it's merely a necessary lift in spending to defend the competitive position of the business. The skew in revisions is also biased towards larger downgrades, with 35% of the top 100 companies experiencing a downgrade to forward earnings forecasts of more than 3%, while only 10% had upgrades of more than 3%. The weaker outlook for profit growth might leave an investor scratching their collective heads given the improvement in NAB Business Confidence Survey in recent months. But as we pointed out in a recent article, this index has improved as a result of the recovery in sentiment in Western Australia and Queensland from very low levels on the back of higher commodity prices. This dynamic is also reflected in positive revisions to resources company earnings forecasts during August. Business sentiment has actually faded in New South Wales and Victoria in recent months. That's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.